Well, hello. We're here at SuperInvestor US 2015. I had the pleasure of talking with Ted Koenig, the President and Chief Exec of Monroe Capital. Ted, there's a lot of excitement and interest in private debt these days. Tell me exactly what Monroe Capital does, what funds you run.
We've been around for about 10 years, and what we do is we're an asset manager in the credit space. We do private debt transactions throughout North America. And what that means is we make loans to companies, middle market companies. We focus on companies mostly 30 million in EBITDA and below, and it's what the banks used to do in the United States, the regional banks.
So you're filling a void that the banks have moved out of.
Exactly.
Now, one of the things that kind of people talk about at all these conferences is risk-adjusted returns. So where does the kind of senior debt, direct lending that you're offering sit on the return and risk spectrum for an investor?
We're at the very top of the capital stack. So we start at the top of the capital stack and then work our way down. So everything we do is first lien lending, and it could be unitranche lending, which means that we'll do the first and second lien, and very often we're the only debt capital in a company's balance sheet. We'll do primarily buyouts, recapitalization transactions, dividends, refinance transactions, but anything that's leveraged. We tend to attach somewhere around 2.5 to 3 turns of cash flow, and we'll go as high as 5 depending upon the company and the industry.
But you're at the top of the capital structures. That sounds like a fairly low risk investment.
Yeah, that's the plan.
What are the stats?
That's the plan.
Usually
there's mezzanine debt or private equity below us. Usually we're about 65 to 70% of the enterprise value, and then the rest of the enterprise value, 30-35%, is either junior capital or equity. If you look at over a 12-year period since we've been doing this, an average bank in the US will budget about 100 to 150 basis points per year for loss. We've been lucky. We've had 33 basis points of loss on a cumulative basis over a 12-year period. So from a return standpoint, our returns have been very strong because we haven't lost money, and we generate good, consistent quarterly income.
Now, Greg Norman, the golfer, once said, "The harder I practice, the luckier I get." You were modest enough to call that luck. What is it that really drives that low loss ratio?
We've spent a tremendous amount of money in building out an infrastructure, and that's on the front end. We have 8 offices throughout the United States, and they're all staffed with 20 to 30-year industry vets. So these are all bankers that have been in the business for quite a long time. We looked at 2,000 transactions in 2014.
Wow.
And we did 50. So we're doing roughly 2.5% of the deals that we look at on the front end. And then we do those deals. We've got another 20 people in the back office that are portfolio account execs that manage those accounts. And every month we're doing our homework and we're checking and rechecking information that comes in.
So that's quite an infrastructure you've built up. So it's hard work, a big investment. Does that mean a lot of the investments you make are non-intermediated? You're
Yeah,
doing it direct?
The key for us is because of the infrastructure, because of the proprietary nature of the channel, most of the investments that we're doing, we're agenting most all of our investments. So we're not buying transactions off the street from arrangers.
You're originating them from the issuer.
That's exactly right.
Wow.
We're originating them directly. We're not buying them. So what that does is it causes a little lower attachment points and leverage and a little better transactions.
Right.
We're looking at better companies, better management teams, and companies with better prospects.
Tremendous. So that's answered the first part of the question. It sounds fairly low down on the risk thing. Does that mean
Yes.
it's low down on the returns as well?
Yeah, well, it is. I mean, we don't generate private equity style returns. We're not looking for 30%, 25% returns. We're not taking private equity risk. We get between 7 and 10% unlevered all in from the company. Right. But then what we do is we leverage our funds a little bit. So we've been able to generate a mid-teens return consistently to our investors over the last 12 years.
So the offer to the investors is really low risk with a mid-teens return. Sounds quite compelling. What do you
Think of it as
find
fixed
from
income.
the investors?
Think of it as a fixed income product. Today, when the U.S. Treasuries are returning less than 2%, and there's a yield challenge in the marketplace, we deliver a fixed income return with a low to mid double digit return, and that's a great product for a fixed income investor.
That sounds pretty attractive for the pension fund who needs an actuarial return of 8% or something with low risk.
Yeah, that's our target investor base. It's all pension funds, universities, endowments, foundations, family offices.
Brilliant. Now, finally, Ted, what are you seeing in the market today? Are we at a peak? Is it still growing? What are you seeing?
There's a lot of capital available. And there's a lot of capital available. The high yield market has really come strong. And in the companies 50 million EBITDA and above are able to generate as much capital as they want today. We purposely play in the 30 million EBITDA and below because the high yield market is not really a factor there. And a lot of the big finance companies don't really play in that market either. So we've carved out a little niche in that space.
Ted, that sounds pretty compelling. Thank you very much, and all wishes for success.
Thank you.
Thanks.